2022 was a rough year. I know. We've been saying that for the past few weeks as we go forward, looking to the changeover into 2023. But it's not just you. It's not just other investors. It's essentially everyone. For stock investors, with or without the assumed insurance of stop orders or trailing stops, and those still following the meme stock craze and crash that we saw prior to 2022 and then again in 2022. For new options traders, those who were lured by promises of the wild returns that were seen in 2020 and still maybe steady returns that existed in 2021 with certain strategies. But of course, all fell prey to the lie of leverage. Even successful and advanced options investors, those that survived the 2020 and previous declines of 2008 and other years, using common strategies that used to win 7, 8, 9 times out of 10, were no longer the same success rate and the losses were piling up. Many popular strategies did not hit their targets. The popular covered call position or the out-of-the-money cash secured selling naked put positions generate income with protection, a good downside protection or a good percent to break even, say on a naked put or cash secured position, trying to hit singles and hopefully preventing home runs being hit against you, large losses that aren't commonly seen in regular markets. But in the uncertain market of 2022, many larger losses than were hoped for were realized with these income-generating strategies. High probability, high return, the power of out-of-the-money credit spreads or even in-the-money debit spreads. Increased return due to the higher implied volatility in the VIX across the market. Good probability, 80-85% or more, that the stock would stay above or below a strike price in a bullish or bearish position. But these strategies do fall prey to the lie of leverage as well. One loss beyond what you can control can wipe out 8, 9, or 10 previous trades. We couldn't just do bullish, bearish, or neutral iron condors consistently. We had to move with the market and switch from bullish to bearish in order to see any reasonable success with these strategies. And of course, everyone wants to go for the home run from time to time, buying options, speculating on the wild returns and the dreams of high return positions. But a lot of these ended up near 100% losses in the uncertain and whipsaw markets of 2022. Using these strategies that may have an infinite or close to infinite upside, which lures in new investors, and of course we all see the dollar signs in our eyes. Do the winning trades outpace the losing trades? Or what we commonly see, the monetary losses start to outpace the monetary gains. Now, about a year ago, we did a presentation, Is it the market, your management, or the structure of the trade that gets you into trouble? Well, we decided it was indeed the structure of some of these common strategies that tended to get investors into trouble over time. The concepts are still relevant after 2022 and especially relevant heading into the uncertainty of 2023. Think about the strategies you've been using, whether you've been moving with the market or the structure of the trade that you've been implementing. Even in a good, quiet, or normal year, will your strategy meet your trading goals? In 2021, we saw the standard melt up with occasional pullbacks. 2009 was a steady and up year, but we had some hiccups in between. And 2017 was pretty good. Would your strategy meet your goals, but would also keep you out of trouble during uncertain times that happened even during these types of years? Does your strategy protect your hard-earned capital going forward and still work for you? This is where the Trade Simulator tool comes in. Let's evaluate our expectations for our strategies with realistic targets of what we expect to make. What is the Trade Simulator tool? This is a free resource at radioactivetrading.com. This tool simulates 100 trades, flipping a coin 100 times. Heads, we win and hit our target return. Tails, we lose we lose the amount of our loss limit. We can enter in our realized success rate that we've had with our strategy, probability of loss, for example, and we can toggle the account size that we're putting in and the allocation to each trade. It simulates what would happen over 100 trades, looking at the high value, the low value, the ending amount over a time, recording the monetary values with strings of winners and losers based on that essential coin flip. Now, the covered call, or out of the money naked put, selling cash secured puts, are very popular strategies. What values would we use? Well, let's say we're doing monthly covered calls. We're going to set a target of 3% return if assigned, or 3% naked yield and a cash secured put. They're essentially parity trades of one another, looking at an in the money covered call or an out of the money naked put. Let's assume we can control our losses to only 7 to 8%. We generate 2.5–3% of premium. Stock unexpectedly falls 10%. We still had that slight hedge in place. We only lose 7, 7.5, or 8%. And let's assume we're right 70% of the time, with or without management. Do we hit our targets? Not exactly. This simulation shows us that we do hit a high value at one point after our first win of $10,150. Well, okay, very small 1.5% return or so. We draw down over time to about $7,000, starting with our $10,000 amount. So we're at about a 30% loss. And over time, we're just about at break even. Really, we're down. What do we need to do with these strategies to hit our goals? Well, let's be honest. 3% per month is a 36% annualized return. That's a little bit high and a little bit of an overpromise. A better target to look for is maybe between 20 to 25% annualized with these strategies. 1.5, maybe 2% return per month. But in order to achieve the goals that we want, we're going to need a higher success rate. And that's under the assumption that with uncertain markets that we've seen recently and maybe heading into going forward, that we're able to keep those losses to only 7 to 8%. Here we see those same numbers, though, targeting a return of 3%, controlling losses to 7.5%, starting off with $10,000. And we see that in order to get to that 20 to 25% return over 100 trades, or maybe even annualized if you're doing that many trades per month, you need a success rate of about 76%. And this can still come with a 13–14% drawdown on the portfolio. Not bad, manageable, but you need the higher success rate with those targets in mind to hit your goals. If we look for a more realistic target of 1.5%, with keeping the losses to maybe 7.5% or so, we're going to need a higher success rate of closer to 80% in order to achieve the proper targets of 20 to 25%. What about the power of high probability? Searching for spread trade positions, out of the money credit spreads, bull put credits, bear call credit spreads, even iron condors that have a probability of success of 75% or more. We can still see double-digit returns on the leveraged risk involved. Is it a low risk because all we're risking is the difference in the strike prices of a credit spread? No, it's a known risk, but we're still risking 100% of what we invest in those positions. Looking at a target return of 15%, fairly reasonable. Trying to control the losses on the full margin requirement, only 50% of the difference in the strike prices, and shooting for that 75% win ratio. Do we hit our targets? Not really. In fact, we're close to almost an 84% drawdown over time. And the ending amount, we're not getting ahead at all. We're down close to about 60%. What we need to hit the spread goals? Well, first off, spread positions and the leverage positions should only be a portion of your portfolio due to the wild swings. 10% of the portfolio, 15% of the total portfolio. Desired targets of a 15% return with a high probability spread trade, but trying to keep the losses to 50%, that's reasonable. But in order to achieve the returns that you're looking for, you're going to need a much higher win rate. Even with those numbers, 75% win rate and possibly an 80% win rate is not going to get you the values you want. You're going to have to target an 82, 83, 84% success rate or higher. But that's still going to come with a 40 or 50% drawdown at one point during the portfolio. That is just the nature of the spread trade position. Of course, we all want to go for the high return. Buying options, speculating on market swings, promises that are out there of 100%, 200%, 300% over our last 6 trades. The use of leverage to be successful, or are investors long-term falling prey to the lie of leverage? Does a lower cost in these situations equal a lower risk? Not without proper position sizing. Just like the spread trades, it's a known risk. You can easily lose 85%, 90%, or 100% of what you invest into speculative long options positions. An average success rate, are you right 50% of the time? Are you right 60% of the time? Are we going to hit our targets? Well, let's say that we go somewhere mid-range between these high promises. Let's target a return of 125%. But let's be realistic and realize that the whipsaw markets and sudden fluctuations we saw in 2022, we could realize losses easily of 80 to 90% or even more. And let's assume we're even right a little bit more than 50% of the time. We're going to look at a probability of loss of only 45%. Starting with that same $10,000, allocating about 33% to each individual trade, well, at one point we can see an immaculate and just enormous potential high-value return with strings of winners and losers. But in order to see that, we're going to have to stomach a low-value drawdown of almost 73, 75% of the total portfolio. Now that's interesting. Would you keep trading a strategy if at one point your portfolio was down 70, 72, or 75% of what you started with? Probably not. You're probably going to abandon that strategy and look for something a little bit different, a little bit more of controlled risk without a lot of fluctuations. But hey, we're hitting well beyond our targets, even being right only 55% of the time. But is that realistic? Actually, I don't think so. The more common outcome, and we recently had a video on this where there was an investor who told us that he had blown up his portfolio twice, buying options, buying calls, and then buying puts. But a more common outcome is even following the desired targets, even having a 50-50 win ratio. In an inconsistent and uncertain market, you can find yourself bankrupt without money to continue trading the strategy after just the halfway point of the 100 trades or even faster, depending on the strings of winners and losers based on the uncertain market conditions. But what if we took that leveraged approach and we were somehow able to successfully manage to keep losses to only 50% of what we put in? Of course, that's going to affect the win ratio slightly. It's also going to affect the positions that we're closing. A more common approach for option buying is to target maybe a 75 to 85% return on the winners, attempting to keep the losses at best to only 50% of the purchase price of the call or the put. You're still going to experience wild swings. And at one point, you'll still fall prey to the lie of leverage, where you're down maybe 60, close to 70% of the total portfolio value that you started with. And again, would you continue that strategy going forward, seeing that percentage loss of what you started out with? So what about a different approach? What about something boring? Could I keep that 50-50 win ratio or close to it, but control risk rather than speculate on wild returns and be successful. It is possible to control risk, leave the upside open, and still get income. We can target a higher return without the capped gains of a covered call, put selling, or even credit or debit spreads. We can guarantee a low risk on those positions without the fickle or assumed insurance of a stop order or a trailing stop, which can be violated and larger losses are taken than expected. We can even take a lower win ratio, say of only 55 or 50%, and the structure will allow us to mute market volatility. Let's say we set a target return of 10.8%, a little bit more than 3 times what we might expect with a covered call, and that's on the high end of the overpromised results. We control losses to only 5.2% of the investment amount, and we take a probability of loss of 44% or so. Start off with $10,000, allocate 50% to each trade, and here we see that with a win ratio of 56%, losing only 44% of the time, a high amount of $61,262 from $10,000, a low value of only $9,239, and an ending amount still near that high range and positive return, beyond maybe what we expected to make for our targets. Okay, well, maybe that 11% is a little bit too high. Let's just double the covered call return as we're starting off with leaving the upside open. Target a return of 6.3%. Keep the loss limit close to even of about 5%. Let's put in a probability of loss of 40% or 60% win ratio. How does that look? Again, over time, flipping the coin, heads we win, tails we lose, we see a high value of around $25,000. The low value, just $250 down, a very small percentage drop. The ending amount, still about the same, close to near the high value, doubling what we started off with. Now, is that even possible? Well, those numbers that I just showed are the posted track records at radioactivetrading.com for the Ernie Z, Ernie Zerenner portfolio, and my portfolio, the Mike C at PowerOp portfolio, where we post our married put positions following the rules in the blueprint and the search on Power Options for the default married put criteria. Over 97 total positions since around 2008 or so. Ernie's average gain on his winners is 10.8%. Average loss on the losers is only 5.2%, with 44% losing positions, 56% winning positions. My portfolio, over 84 trades over a shorter time period, well, just from 2008 to 2022. Average gains on the winners, 6.3%. Average loss on the losers, 5%, with a win ratio of 60%, losing only 40% of the total trades. These are actually what have been posted, so it is possible, and it is what we show on the site. Now let's table that to look at a view side by side using the best outcome, really the realistic outcome for each one of the strategies. Remember, starting off with only $10,000 for each. Covered calls, naked put selling, we kept that overpromised high return of 3% per month roughly. A loss limit of 7.5%, assuming, of course, we can keep that. Probability of loss, 25% or 75% win ratio. And we saw with the success rate we needed of about 76%, it was possible to have a high value of 12,389 in the simulation, or 23.9% from where we started off. The low value, 8,663, is down about 13.4%. And the ending value, well, that was equal to the high value, the gain of roughly 24%. Inside that target range we want, but remember, this is after 100 trades. If I only opened 3 covered call or 3 naked put positions a month, that would only be 36 trades over the year. It'd take me 3 years to get to the 100 trades or so. Now, The out-of-the-money credit spreads. Targeting a 15% return is reasonable. Trying to control losses to only 50%. Probability of loss, 20%, looking for an 80% win ratio. And we did see that when we were right, 83, 84% of the time, we could see a very high return that you're probably expecting with the leverage spread trades. But the lie of leverage works both ways. You'd have to assume a drawdown of near 50% at one point in the portfolio in order to achieve the goals that you wanted to see. And the ending value, of course, still around the targets that you'd want. But again, would you stay in a strategy where you saw your portfolio down 40, 45, 50% or more at one point or another during the trade? Option buying, we saw those extreme high returns. Of course, we were targeting a return of 125%. That can happen from time to time, but it's not consistent. Again, of course, we know we can lose near 100%, especially in uncertain markets. We've had several presentations about managing long calls and managing long puts that are near full loss during 2022. We're still keeping that only 55% win rate or 45% loss rate, and you see these high percentage in the thousands, 4,560% high value, 2,203% ending value, but you had to stomach a 72% drawdown in the portfolio in order to see that long term. And again, the more common approach, and what we've seen time and time again in uncertain whipsaw markets, is that although the high return can be seen at one point or another, eventually the portfolio gets wiped out to near 98% loss in our simulation. You're essentially bankrupt and don't have the money to keep continuing to buy options going forward. Now we compare that to the protective radioactive positions, the radioactive profit machines or RPMs. Ernie's track record, 10.8% average return on the winners, 5.2% average loss on the losers, 56% win ratio, simulation that we saw, high return, and again, only a drawdown of 6.6% even in uncertain markets. And then, of course, the other one, lower return of 6.3%, still controlling losses to only 5%, having a 60% win ratio or 40% probability of loss entered into the trade simulator tool. We see the values that we could have for the return going forward and a small drawdown in the portfolio as we'd expect with the proper structure and controlling risk guaranteed. And is that even possible? Keeping risk guaranteed to single digits while seeing positive outcomes? Well, the RPMs, the radioactive profit machines, were the only ones on that table with single-digit losses. We already showed that it was possible with the track records posted at radioactivetrading.com. Now, are these simulations actual portfolio returns? No, this is a simulation of what is possible to help guide you to meet your targets for investing and why the structure of your current trades might not match that, even in normal, quiet, or strong markets. But check your numbers. Go to the Trade Simulator tool, radioactivetrading.com, click on the Resources tab, and then click on the Trade Simulator. Here's the direct link, or you can click the link that just came up in that pop-up window. Enter your realized or targeted returns and your loss limits you're shooting for. Enter in your portfolio size and the allocation of each trade in your strategy from that portfolio value. Run the simulation. Are you meeting your goals over time? Does it beat the values we just showed you when you're controlling risk guaranteed in the radioactive profit machine format? If not, you should consider the blueprint going forward to 2023 and beyond. The blueprint, of course, is the full course on controlling risk with the preferred structure, generating income to further lower that initial at risk while also lowering the break-even to extend potential profits, and over 12 ways, what we call the income methods, to adjust the position to lower that initial at risk, get income, or lower the break even in different market conditions. And now, of course, is the best time to get the blueprint. If you get the blueprint before December 31st at midnight, you'll lock in the 8 special end-of-year bonuses. You'll get access to that Fusion subscription for only $10 per month for the first 2 months, and you can activate that at any time. We'll give you one of the Mastery Series videos for free. You'll have electronic access to that link available immediately after purchase. We'll also include another video, the 5th video, the 4 Insider Secrets of Trading. You'll have access to the Quick Start Guide to eliminate the guesswork on how to transition from covered calls, spread trading, or other strategies into protective trading. You'll also receive 1 month of Power Options free to access the patented search tool, as well as track, manage, and evaluate rollout opportunities or income methods using the portfolio tools. The blueprint is an all-electronic copy, so you'll receive instant access right away. You'll have full support from myself, from Ernie, and other Power Options and Radioactive staff members for free. Of course, you'll also have instant access to members-only webinars and white papers to help you smooth the transition and accelerate your learning curve to master the materials in the Blueprint course as well. Head on over to radioactivetrading.com/EOY, or just go to radioactivetrading.com and click the Products tab to get your Blueprint before December 31st at midnight. If you're not seeing or meeting your trading goals, or if the simulator tool shows you that you won't be meeting those over time, get the strategy, the concepts of the strategy that will protect your portfolio, will allow you to control risk while still being able to get the income desired and hit the target goals. And of course, you pick up the blueprint before December 31st at midnight, you'll lock in the 8 special bonuses as well.